There's a dizzying array of support options available to founders. Are you finding it difficult to assess what kind of support is right for you to help you on your journey to product market fit? Until you've had experience with every one of these support options, it's very hard to know what the strengths and weaknesses of each one is. It's no wonder founders have challenges. There are some great support options out there. We've broken each of these down to help you understand the strengths and weaknesses of each option and how you might want to assess the quality of the options that you find to help you to make an effective decision. We hope this video will help you assess the support options that are right for you. Let's look first at angel investors. Angel investors invest at idea or early stage in exchange for equity. They either like to invest money or money in their support, whether that's industry and networks, or they may have startup building experience. Many angel investors are also part of angel groups who make investing decisions together. There are many diverse types of angel investors. The best investors have deep experience in building startups and will help you to do the right thing. Once they've invested in you, the best angel investors are likely to be aligned in supporting you to explore your idea rather than push too early for growth. But it can be hard to find and match with the right investor, and you'll need to be competitive as an investment opportunity to attract their attention. We're finding that angel investors are investing slightly later as well, so although ideally they should invest in idea stage, many are now asking to see MVPs and products in market. It can take a lot of applications and rejections to find the right angel investor. One big weakness of the model is that there's no professional oversight like you get with other professions, as it's not a professionalized industry. And also, money does not equate to startup experience. You'll either want to seek an angel who really understands how to build startups, or if they have industry experience or networks, then you may need additional startup building support. To assess the quality of angel investors that you meet, look for angel investors who support you appropriately based on the stage that you're at. For example, angel investors shouldn't push you to grow too early before you've reached product market fit. Speak to other founders that those angels have worked with to get an idea of whether they are a good fit for you. Let's look next at venture capital or VC funds. Now, they raise money from limited partners to invest in startups, and they offer funding in exchange for equity. Many VCs get involved once you have a product in market, though some do invest earlier, and a scalable business model hypothesis with evidence of traction. Typically, VCs have a specific investment thesis, whether it's industry, location, founder demographics, or tech. You must meet that thesis to be considered for investment by that fund. Now, the best VCs can be a great option if you've already reached product market fit, as their experience and networks can help you to scale. The best VCs will also help you to reach product market fit and not compel you to scale before you've achieved that. However, one weakness of the VC model is that VCs tend to be resource constrained. You're often better off to be a startup they invest in at the start of the life cycle of their fund, as you're more likely to get more support. VCs can be light on systems, processes, and QA because they are resource constrained, which makes it harder for them to invest in systems and process. Instead, the VC model relies heavily on lived experience of individuals at the fund. Remember also that their primary customers are investors into the fund, and their priority is to identify and pick winners within their portfolio that can deliver outsized returns. Depending on the VC, this can mean that they can be either focused prematurely on scale or light touch, especially if you don't demonstrate that winning potential. VCs are competitive entry, and each VC has a different application process. It's very competitive to get into the best VCs. In order to assess quality, you'll want to speak to several founders from their portfolio companies to understand a few things. 1, how much support they provide. 2, how custom is that support based on the founder's situation. 3, are they pushing for growth before the founder has reached product market fit? 4, are they helpful in board meetings? Do they follow through on actions that they've agreed to? And then maybe other questions that you want to ask. This will help you to understand if that VC is the right fit for you. Let's look next at venture studios. There are various types of venture studios, but they do tend to be collaborative and take on a co-founder role with a small number of startups for an equity share. Many of the best venture studios help founders to be highly capitally efficient, as they bring unique skills that a founder may need or lack, like product development, branding, marketing, sales, finance. And venture studios do tend to be holistic in their approach because they focus on company building. However, the best venture studios are extremely competitive to enter, and you need to fit their investment or their thesis or niche. Most venture studios take on a small number of startups as they have a services-centric model, and you're also likely to give up a significant amount of equity in order to participate. One weakness with the model that you'll want to consider is if they offer support for sweat equity only, as opposed to actually putting any cash in. The barrier to entry for new studios can be very low, which can mean there's a lot of players in this space who are still early on that learning curve. So tips for quality. So check their model to see if they offer sweat equity or if they also invest cash, because that'll give you an idea of actually their model. And you'll want to speak to their founders and look at the milestones that they've supported startups to reach to see if they're going to be a good fit for you and your needs. Let's look next at equity accelerator programs. So equity accelerators are an intense, usually 3-month program where you're given an intense level of support during that time period. Accelerator programs typically culminate in a demo day where your cohort of founders pitch for investment. Now you get mentoring, education, networking, and access to peers on the program, funding, and the opportunity for follow-on funding in later rounds. At the very best accelerator programs, that experience alone is likely to set you up with a great chance for success. However, equity accelerators are program-centric, so you usually have to be in that location or willing to move, and you get access to the same structure and content as the rest of the cohort, irrespective of your situation. The mentors are typically volunteer, so you're reliant on their lived experience and the time that they can allocate to the program. Mentors can have a lot of opinions that may not have been well thought through or aligned with other mentors at the program, which founders then have to navigate themselves. This is unlike a consulting firm, for example, where the team tends to get on the same page before they support you, so it puts a lot of the navigation onto you as a founder. Remember also that the primary customer for accelerator programs is their sponsors, so you may find that they're misaligned in supporting you through the early customer discovery stages. Also, it can be hard to find and be accepted into the right accelerator program for you. You do need a level of maturity to be able to take advantage of an equity accelerator program. Many founders that we meet do wish that they'd actually gone through an accelerator before they'd gone through an equity accelerator so that they could take best advantage of the accelerator that they're in and get the most out of it. So tips to assess quality. So look at the quality of the alumni, the experience of the mentors, and follow-on funding success rates to help you to measure whether a program is the right fit for you. Also, you want to check, are the mentors investors? Because if they are, there can be strong alignment and real buy-in to the success of your startup. But if the mentors aren't also investors, the support you get can be much more transactional. This also avoids programs that focus more on vanity metrics rather than building companies. So non-equity accelerator programs, they share many of the same characteristics, strengths and weaknesses as equity accelerators. The core difference being that you don't need to give up equity in response for support. The best non-equity accelerator programs offer you mentoring, education and networking, and again, you don't have to give up any equity in your startup. Now, the model does have many of the same weaknesses as equity accelerators. It's a program-centric experience, which may not meet you exactly where you're at, and it may not support you with what you need at the time that you need it. Again, their primary customers are their sponsors, which can again mean a bias for vanity metrics over company building metrics because they need to demonstrate short-term progress to sponsors. This is different though to equity-based accelerators who do tend to be in it with their startups for the long haul. Again, with non-equity accelerators, there can be a lack of oversight in systems, which again means that diversity of mentors can be a double-edged sword, with founders having to still navigate conflicting guidance. The quality of the alumni and the experience of the mentors matters. As many mentors are unlikely to be investors, the support you get as a founder is even more likely to be much more transactional, so it may not be such a great fit for you. Let's look next at professional services. So professional services include software development agencies, marketing agencies, PR agencies, and potentially others. Many of the best professional services companies are deeply expert in their domain. They do the work for you and can get you great results as long as you have clarity on who your customers are and why they need your product. However, due to the model, their greatest strength can be a weakness. So professional services firms that specialise in a particular area, like law or marketing, tend to be less able to take a holistic view of your startup, which can be a challenge if they or you hit roadblocks that are outside of their domain expertise. So to assess quality, you'll want to speak to their clients to see if they are a good fit for you, and ask if they have a process and IP to support the lived experience within their team. You'll want to make sure who's working on your project, as junior staff can be the ones doing the actual work for you. Ideally, you'd use a startup coach to help you to prioritise which professional services you need and when. Let's look next at paid startup advisors. So they are individuals that you can hire to advise you based on their skill sets, whether that's go-to-market strategy, sales, or industry knowledge. They tend to be post-exit founders and can be very experienced angel investors. Now, the best paid startup advisors are highly experienced and can really help you with both capital efficiency and also reducing your risks. This is particularly true if they've built multiple startups themselves, or if they've worked with many founders, or if they provide other support like access to networks. Usually, paid startup advisors are paid on retainer, which can also make them highly aligned with your goals. Some of the challenges are that the experience that they have can be hard for you to put into practice once you try and actually implement the things you've learned from them yourself. Usually, paid advisors don't have a documented system and process behind them that you can then take advantage of, as their guidance is based on their lived experience. For that reason, it's possible that their experience can become dated if their experience comes from a reasonable amount of time ago, as things move so quickly in startup land. As there are no professional standards, qualifications, or certification, picking the best startup advisors can be very challenging for you to do. In terms of tips for assessing quality, speak to their founders to see the impact that they've had from working with these paid advisors, and look at their experience to check that they do have deep startup expertise. Next, a board of directors. So a board of directors is a legally recognised body responsible for the governance and decision making of a startup. The board of directors typically includes founders and investors. The best boards of directors are likely to be experienced with startup business models, and individuals are going to sit on multiple startup boards. They're likely to support your startup to be capitally efficient and help you to reduce risks. However, it is unusual for directors to get involved on an operational level, which can be where you need the most help. If you're fairly early in your startup journey, you'll want to check their bias for strategy as well as for governance, and their startup expertise and experience. Typically, you can do this by checking out their credentials and speaking to founders whose boards they sit on. Next, a board of advisors. So a board of advisors is a non-binding group of advisors that provide strategic guidance and support to you as a founder. The best advisors are typically strategic. It's quite a low barrier for you to establish, as you can ask people to be on your board of advisors. It's not competitive entry, so it can be straightforward for you to set up, and you can establish their credibility quite easily, as you can look up their LinkedIn profile or check the startups that they're advising. One challenge with this model, though, is that the advisors that you pick may not have much skin in the game of actually supporting you on your journey, and so they may not be as focused on the success of your startup. They may be more focused on a particular discipline like AI or a particular industry rather than startup expertise. In order to assess quality, you want to check that they're credible in the area that they are experts in, as well as the usefulness of their support to other founders that they advise to help you make a decision around whether they are individually and as a board a good fit for you. Next, let's look at industry courses. So these include courses in topics such as marketing, software development. All of these types of courses are designed to help you to upskill in core areas. Now, the best of these can be highly relevant and effective and can support you with capital efficiency. The content is usually really relevant and up to date in terms of current practice. But there are so many industry courses in different subjects, it can be hard to understand which one is right for you at any given point in time. The strategy of choosing the right industry course is the challenging element. These courses also assume that you'll prioritise learning and putting in place the actions, but founders can be left struggling to prioritise the course and its practical application within their startup. Many industry courses are also specific to a topic and can lack specialisation to startups where they can be hard to put into place. To assess for quality, speak to other founders who've been through these courses and also use a startup coach to help you to prioritise which course to take and the quality of those courses. Academic courses are focused on attaining a qualification. They can include entrepreneurship and startup courses that you can get at universities, some of which may also have a combined programme with an academic unit like biosciences. Now, the very best of these courses have high credibility with some stakeholders. They may have access to networks and equipment or labs and actively support founders as they learn. But one weakness of this model in supporting startups is that they can be based on you attaining a qualification rather than directly building a startup. As a result, they're program-centric in the approach that they support founders with, and founders are having to fit with the program itself rather than the course fitting with the specific needs of a founder and potentially their team. So how do you assess quality? So in order to choose the right academic course for you, you may want to consider choosing micro courses that are highly specific to exactly what you need and make sure that the curriculum is kept up to date. You may also want to use a startup coach to help you to prioritise which course might be right for you and the quality of those courses. So education platforms often have a decent level of startup guidance to get you started on the journey and support you with a base layer of knowledge, which can be critical at the start of your journey if you're just starting out as a first-time founder. The model itself is very cost effective and it's available on demand, so you can access the information as you need it. But it can be hard to prioritise the training, and many of these education platforms actually lack specialist startup support and coaching that goes alongside that training. Ideally, you'd use a startup coach to help you to prioritise which training to complete and the priority of actually completing the actions alongside any other startup building that you're doing. Networking groups, now these can help you to meet other entrepreneurs or startup founders, whether that's online or in real life. They do have very real value, particularly so you can meet others who are on the journey with you, whether that's to celebrate successes or to commiserate, or as an opportunity to learn from each other. Now, some of the strengths of networking groups, particularly the best ones, is that they have a low barrier to entry and it's possible to build really high trust relationships within these groups. But there are weaknesses to networking groups as a support model, particularly if you look for groups that have founders in them, because the startup expertise varies between networks. An approach that may have worked for another founder may not work for you in your context and with your specific needs. In terms of assessing quality, so you'll want to look for groups with like-minded individuals in them, and if you're seeking expert help, make sure that you validate that there is startup expertise in the group rather than relying on an individual's own experience. Fractional resources. Now these include resources that you can access who have expertise in an area like marketing, financial modelling, and you have access to some of their time to help you in a business area or with a particular project. Now, the best fractional resources can be very capitally efficient. You can get some high quality outputs from the best fractional resources. They help you to make operational progress, particularly when you're looking to set something up. They tend to be retainer based, so they have a longer term strategic focus. But there are some weaknesses with this model. They can be quite high cost, and due to their lack of systems and processes in many of these types of businesses, it can mean it's harder to transfer those skills into your team at the right time. They're also strategic for a function rather than strategic cross-functionally like a startup advisor might be. You'll also want to ensure that they have startup specific experience. Financial modelling is a great example of this. It's very different in the startup space versus the established business space. And so in terms of assessing quality of any fractional resources, you'll want to make sure they have startup experience, and you'll also want to make sure that you can transfer skills into your team over time. Let's look next at hiring staff. So you can hire staff to carry out roles or fill skills gaps in your startup. And every startup is likely to need to hire staff at some point. As long as you're focused on hiring the right people at the right time, typically when you're early in your journey, these are generalists who can work on what the business needs, which often changes frequently. Then as you grow, often you'll move to more specialist skills and specialist hires. With the right team members, you can make much more operational progress and stay aligned with your team, and the team members' skills and capability increase over time. However, usually you can't afford to hire the very best candidates to start with, so you do need to hire for potential. Even with a great hire, there is a training and development cost. It can take time to build the quality and efficiency of their contribution to the team. So tips for quality when hiring. You'll want to seek out hires with a growth mindset who are passionate and aligned with your purpose, particularly given the ups and downs that working at a startup can entail. You'll want to hire people who are conscientious and focused on getting the job done, and also who have a high EQ and IQ to make them easier to work with. Now, many founders decide to find a co-founder to go on the journey with them and split equity between them. Data shows that more co-founders are a proven indicator of higher rates of startup success. Ideal co-founders have complementary yet diverse skill sets, background and temperament. The best co-founders are able to collaborate and challenge each other to support each other on the journey to product market fit and to maximise your rate of progress. If you have a great co-founder, there are few weaknesses. However, many founders that we meet rushed into a co-founder partnership, and once set up, it can be hard to dissolve. To help you to assess a potential co-founder, you'll want to consider many of the same things around hiring staff, but of course the stakes are higher. So things like having a shared growth mindset, that you're aligned on a shared purpose, and really importantly for co-founders, that you have realistic goals and timeframes for actually reaching those goals. It almost always takes longer than you think to get to traction and product market fit. You'll both need to have high EQ and IQ, and you'll want to make sure that your personality traits and experience are complementary. Now, there are a growing number of software solutions to help you at various points of the startup journey, whether that's to help you design a business model hypothesis, set up a cap table, to name a few solutions. Now, these can often be cost effective to implement. However, they are often point solutions to help you with parts of the startup journey, and they can be inflexible outside of that particular component. You want to make sure that they're fit for purpose to help you with a specific need that you have by checking their reviews and speaking to other founders who have used that solution. Let's look next at self-directed education. So you can self-teach using the very best startup books, courses, and information that you can get at networking events. All founders are going to have to use self-directed education to a certain extent. Now, you can get a high return on investment from the very best resources. However, there is a high upfront time investment. It can be hard to choose what you spend time educating yourself on, and it can be expensive in terms of your time if you pick the wrong thing at the wrong time. If you have a startup advisor, they can help you to make decisions about how best to spend your time. Lastly, let's look at LeapSheep. So we help early stage founders avoid the startup graveyard by guiding them from idea to product market fit. LeapSheep's been designed specifically for founders to take the best parts of the models that we've spoken about so far and leave out the weaknesses of those models. Our support is accessible to all startup founders. There's no competitive entry. As we're subscription based, we are goal aligned with founders. So the more we support founders to be successful, the longer founders subscribe with us. Our guidance is also completely personalised to a founder's individual situation, needs, and previous experience. We're systems driven, so whilst we use frameworks based on industry best practice that we've tested with hundreds of founders all over the world, we then have trained startup experts to personalise and customise those frameworks for each founder. The weaknesses of our model is that we don't do the work for you. We help and we set the strategy, and then the actual work itself is to be done by you. And we also don't provide capital, so we don't invest in the startups that we work with. In terms of tips to assess quality, so please look at our founder success rates, watch our testimonials, and speak to the founders that we have worked with. That's the best way to assess the quality of working with Leapsheep and whether it's a good fit for you. So now that we've looked at all of these support options, think about what your needs are, and we hope that this video has given you some information that can help to decide the selection of support options that are the best fit for you. Thanks.